Don't file your tax return before watching this video. Hi everyone, Tuan Duong, founder of Tax Quantity Surveys, here for another video designed to help you become a better property investor. So you've bought an investment property and your accountant's telling you that you can potentially claim thousands and thousands of dollars in tax depreciation on it. You'll need to order a depreciation schedule, but when should you get your depreciation schedule? And is there a specific date you should get one? The short answer is yes. You want to listen carefully to this one. Before we get into it, we want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. Approaching settlement. The ideal time to purchase a tax depreciation schedule would be immediately after you settle on the property, especially if you have tenants moving into the property shortly after. This will allow us to finish the site inspection more efficiently because we'll have access to an empty site and we can avoid disrupting your new tenants. In our experience, we've found that we can book an inspection and head out to the property in a much shorter time because we won't have to balance too many schedules. Ultimately, this allows us to produce your tax depreciation schedule much faster. Approaching the end of financial year. Another good time to get your hands on a depreciation schedule is just before the end of financial year. This way, your accountant can have all the information on hand to lodge your tax return immediately after receiving your notice of assessment or group certificate. One of the frequently asked questions is, what's the point of purchasing a tax depreciation schedule if I just recently settled on the property and the end of financial year is approaching already? Well, we pro-rata all reports to ensure that your claims are not missed. This means that there may be a few $1,000s of tax deductions available even in a very short time span. This is due to immediate write-offs and low value pool. So for example, Michael settled on his property on the 19th of June 2020 and still managed to claim $2,394 in plant and equipment depreciation and $239 in capital work deductions before the 30th of June 2020. So in just 11 days, Michael could claim a depreciation deduction on total of $2,633. Vacating your home. If you're planning to vacate your home and turn it into a rental property, it would be best to organise to have a quantity surveyor assess the property in the period after you've left but before the tenants move in. Not only is it good for the relationship with your tenant not to disturb them as soon as they move in, but also we can work closely with you throughout the home to understand what upgrades you have completed as part of the renovations. Yep, you heard it right. You are entitled to claim renovations you did and even any renovations previous owners completed. Backdating claims. Finally, tax depreciation schedules can be backdated for up to 2 years after you've bought the property. This means you can amend your tax returns and include the numbers you missed out on over the last 2 years. Hopefully, this video has given you a better understanding of when you should get your hands on a depreciation schedule. To find out more about tax depreciation, make sure to check out some of our other videos on our YouTube channel and subscribe for more. I'm Tuan Duong. I'll see you next time.